As we continue to watch this play out, Jerome Powell is going to have some tough decisions to make here. Are investors just watching him, or do you think that investors will start trying to front run what they believe he will do? Do you see there being some other strategy for investors? It seems like a lot of people are sitting in cash or treasuries. They're trying to kind of figure out what to do. Real estate, there's almost like no deals happening, right? We've seen massive drop off because the cost of capital has spiked so significantly. We've seen a lot of stocks fall. Many of them have not yet recovered. Bitcoin seems to be one of the unique ones where it fell and it's recovered pretty significantly, but it's still down, 50% or so from its all-time high. What are investors going to do? What do you think they should be doing in this type of scenario?
Yeah, in our view, because again, we have the view that there's going to come a time where that private sector money deflation is not being offset by the public sector money reflation. It will eventually, but I think there's going to be a window of time that could be multiple quarters where that is not the case, where that public sector money reflation is not offsetting the private sector money deflation. This is happening globally, by the way. If you look at narrow money growth globally on a world PPP weighted basis, it's actually declining for the first time ever, the time series, on a year-over-year basis. And so we have considerable private sector money deflation on us right now. It's just being offset for now. So in terms of what I think markets are doing, I think they're front running the Fed. Markets are always trying to front run and game the Fed, right? If you look at the bond market, particularly the shorter end of the bond market, the money market curves, they're pricing in some pretty significant rate cuts over the next 12 to 18 months. In fact, if you look at the Eurodollar curve, we're talking about 3 full rate cuts by the end of the year. So that's a pretty significant move. And I think that pricing in markets is effectively allowing investors to sort of buttress risk assets in the context of not seeing more private sector money deflation. That might be the theme of this interview, right? In the context of markets being able to say, well, we know the Fed's about to be easy, so I can speculate. That's totally fine. And I think that's a very appropriate thing to do at this phase of the market cycle. I think as you roll the clock forward, maybe 1, perhaps 2 quarters, I think the actual private sector money deflation will be too great for investors to speculate with. You're going to actually need that offsetting public sector money reflation. And so I think the most appropriate thing to do as an investor, from our perspective, is to be reducing your risk at certain price levels. We actually had a 30K price target on Bitcoin a few weeks ago. Said, hey, look, it's probably going to go to 30K. I think I would be selling it at 30K. Obviously, this is not the program to tell people to sell Bitcoin, but that's our view for institutional investors, folks who are actually trying to risk manage the capital market cycle. Broadly speaking, equities, I think equities have a lot more downside in delta adjusted terms and volatility adjusted terms than Bitcoin, because I think Bitcoin is actually undergoing what could potentially be a regime change. It's actually becoming the digital gold that it was marketed as for a long period of time, but technically wasn't. It was really just a high beta speculative risk asset, and it's now actually pulling forward some of these digital gold transitive properties. And so ultimately, I think that probably will insulate its downside, again, on a volatility adjusted basis. More of it's a high beta asset, so it's going to go down more if the S&P goes down a lot. But again, I don't think you need to be overly concerned about Bitcoin retesting its lows in a way that I do think you need to be concerned about the stock market retesting its lows. Because again, the stock market has not only these liquidity dynamics and these growth dynamics to contend with, it also has earnings. We're about to go into potentially be a very deep earnings recession. At the bare minimum, I think we're going to get a pretty deep earnings recession. And not only will it be deep in delta terms, it's also going to be deep in expectations terms. You pull up Bloomberg consensus earnings estimates, they're talking about earnings are going to be growing 10% in Q4 year over year. They could be down 30. You know what I mean? Like, seriously, our model suggests that recession is likely to commence in the fourth quarter of this year. So they could easily be down 30. So, in our opinion, I think the stock market is probably the most dangerous asset class here. Gun to my head, I'd rather be long Bitcoin here than the stock market. But the reality is I'd probably be selling both.